Welcome to Smart Spreads. Our goal is simple: to help traders better understand the markets, structures, and seasonal forces that drive commodity spread performance. In this video, we'll examine an important concept that can help improve trade selection, risk management, and overall market understanding. In my last two videos, we explored how to read forward curves and why carry can provide an important edge when evaluating commodity spread opportunities. But carry is only the beginning. Today, we're taking the next step by looking at one of three behavioral characteristics I use to evaluate every commodity spread opportunity: direction. The research behind this series began with hundreds of thousands of possible commodity spread combinations. After applying a rigorous filtering process, that universe was narrowed to more than 31,000 qualified historical trades across dozens of commodity markets over a 10-year period of time. The question then became, how do you identify the very best opportunities from those 31,000 trades? I evaluate every spread using three behavioral characteristics: direction, pace, which is how fast the trade moves, and dispersion, which is how consistent have historical outcomes been. Today we will focus on the first of those, which is direction. Many traders assume buying and selling are simply opposite sides of the same trade. Historical data tells a very different story. Rather than starting with an opinion, I let the historical evidence determine which direction has consistently produced the strongest results. Let's look at three examples. We'll begin with heating oil. Buying two-leg heating oil spreads produced an average profit of nearly $1,900 with an 82% win rate and only a 6% large loss frequency. Selling the same market actually lost money on average and experienced large losses 43% of the time. Same market, same spread structure, completely different outcome. Soybeans tells the opposite story. Here, selling produced positive historical returns with a 68% win rate, while buying generated a negative average return and won less than 20% of the time. The lesson is simple. The data, not our opinion, determines the preferred direction. Lean hogs offers another important lesson. Buying produced exceptional historical results, averaging more than $1,800 of profit per trade with an 87% win rate. But those results came from only 15 qualifying trades. Selling generated much more modest returns, yet produced over 1,500 opportunities. Historical performance isn't just about how well a trade performs, it's also about how often those opportunities occur. Performance and frequency. That's one of the biggest insights from this research. The best trading opportunities combine strong historical performance with enough frequency to make those results meaningful and repeatable. Both characteristics matter. Data over opinion. Another big advantage of systematic historical research is that it removes emotion from the decision-making process. Instead of asking, should I buy or sell this spread, I ask, what has historically worked the best? Sometimes the answer is buying, sometimes it's selling, and sometimes the best trade is no trade at all. Direction is only the first piece of the puzzle. In the next video, we'll explore the second behavioral characteristic, pace, and examine how quickly a commodity spread moves can be just as important as choosing the correct direction. Thanks for watching. If you enjoyed this video, visit bullstrangle.com for additional research, education, and the Smart Spreads newsletter. For a deeper dive into commodity spread trading, be sure to check out my book, Trading Commodity Spreads, which is available on Amazon. We'll see you in the next video.